We'll talk about 5 really advantages to owning real estate, and then we'll lay out 3 disadvantages. So one of the first advantages I think that a lot of people don't realize is the absolute return. It's not just about cash flow or appreciation, but absolute return really takes into account depreciation as well as, any potential losses that you can carry year to year. Guys, Tom or Zuber, what do you guys think about the absolute return aspect as part of the benefits of real estate?
Yeah, I'll let Zuber comment, but we have to talk about his background briefly. So maybe like 30 seconds, Zuber, just give us a high level who you are and what you've done to date.
Yeah, so my background is kind of the rat race on steroids. I believe you go to school, get a good education so you can make a lot of money. That's what I did. Got an undergraduate degree, got a MBA, made a bunch of money, but spent it all. I didn't get it, right? I increased my lifestyle as my income went up. I went ahead and invested in the stock market during the dot-com craze. Yes, I'm nearly 50. So that's where I cut my teeth. I turned $7,000 into 200, only to lose 80% of that in the crash because I became a speculator, but still called myself an investor. So some folks out there listening may be going through this for the first time today. It's kind of weird that we're revisiting this again as we go from a bull to a bear market where pain is ensuing. But after losing 80% or $160,000, which is more money than my family had ever seen, I go through a physical bookstore. I bump into a purple book that we now call Rich Dad, Poor Dad, and it sent me on another direction. So over the next 15 years, I built up a real estate portfolio while holding a demanding full-time job in a market that's 2.5 hours away. I've had property management since day one, no special access, all out of the MLS. Was buying starting in 2002, which if you know the real estate market means pre-crash. I got out of my houses at the peak because I was watching affordability, 1031 into apartments, raised a bunch of private money during the crash, and lo and behold, we replaced 2 6-figure incomes at the 15-year mark and have been given back since then. So I've been in real estate for 21, 22 years. So that's my background.
Awesome. And then, so definitely a seasoned investor in real estate, mogul, if you will. But but back to the absolute return. I have my take, but Zuber, what is your take?
Well, again, so I have the unfair advantage of being 20 some years into this. One of the things that really suffers for new real estate investors, right? If that's your primary focus, is it's so slow those first couple of years, right? Oh, I scrounge up 10, 15, 20 grand. I put it down. I get my rental. It cash flows $100. It doesn't move the needle. You're right. It doesn't move the needle. And in fact, it probably won't move the needle for 5 years. I want you to plan for that. But then something amazing happens with real estate once you realize that time in the market beats timing the market. First, you have mortgage pay down. Then you have this wonderful thing called inflation. Yes, I said wonderful. You have both asset inflation and rent inflation. If you follow my one rental at a time strategy, you have fixed rate debt. So your debt structure stays, yes, you have insurance going up and taxes, but for the most part, your cost or expense structure is the same. So somewhere between year 3 and year 6, you will have some opportunities to recycle capital. This was a huge piece of my retirement. We recycled stuff via a cash out refi. We did 1031 exchanges. We did BRRRRs. There are so many ways that you can reuse capital. So for example, that first $20,000 I put down on Norris Drive has been recycled 3 or 4 times. That is now 23 or 24 units. $500,000 in equity and 100 grand in the bank. So when you think total return with real estate, you have to think time, because too many people go, oh, I struggle. It's hard to get a down payment. And then I get $100, $300, $400. It doesn't change my life. Real estate won't change your life in 5 years. But if you do it for 10 years, shoot, you'd be shocked. I believe most people can make work optional if you give it 10 years. So that's kind of my thoughts, and happy to go any direction you want.
Yeah, and I just create a more concise 100% equity pay down, which essentially is your tenant paying down your mortgage, right? Mm-hmm. That's always nice. You have inflation, the 3 to 5% typically each year. You have the cash flow from rents. Sometimes in this market, hard to come by, but they're still out there. And then you have the tax write-offs, and we'll avoid that topic for this conversation, but I think a lot of investors focus on top line and cash flow, but they miss the tax part of it. And that's a huge element too. And we had Brandon Hall on during my conference, And I asked him, what is the most tax advantage asset to own? He said, without a doubt, real estate.
Oh,
It used to be oil and nat gas,
Mhm.
but it's 100% now real estate. So Mitch, what do you think about
I
that?
completely agree with you. I think, that's exactly how I've built my net worth. A guy that's been involved in publicly traded investment products for almost 20 years. You would think that most of my net worth would come from that. And in the last 8 years, since I've been building my own personal real estate portfolio, I am able, if I sold all my assets, which I won't, but if I would be able to essentially, dictate my future without ever having to go work for anybody else, unless I really wanted to. And so I think that power is immense. And one of the things that you mentioned was, doing those cash out refis. And, frankly, I'll always preface this. I may not be the smartest, but I certainly got in at the right time because, it really has been phenomenal. I don't claim to be an expert in real estate. There's a bit of it that I've gotten lucky with the appreciation in the housing and certainly with where mortgage rates have been. And it just has allowed me to not just do a cash out refi, but actually get a better rate. And then you take that money and you replicate the exact same thing. So it's been quite nice.
Yeah. And Mitch, not to get too complex here, but I think for all listeners, check out something called the Sharpe ratio, which is kind of a traditional way of looking at portfolios. It basically is a way to measure risk and return. And if you look at the linearity of real estate versus stocks, yes, we had the '08 crash, but without a doubt, real estate is way more linear. The volatility is way lower than stocks. And generally, you're still looking at a 12 to 18% annual return when you factor all these things together pretty easily. It's pretty hard to argue to not have real estate as part of your portfolio.